Let's also bring in our special guest joining in live and exclusive on ET now, Dr. C. Rangarajan, Chairman of the Prime Minister's Economic Advisory Council from New Delhi. Dr. Rangarajan, your reaction to the 0.25 percentage point rate cut, and more importantly, the RBI's commentary saying that there's little room for further rate cuts despite its pro-growth stance.
Well, I think it's a move in the right direction. I think almost everyone was expecting it because of the fact that the budget had taken a strong decision to contain fiscal deficit, and the non-food manufacturing inflation has been brought down below 4%. These were favorable factors providing space for the Reserve Bank of India to move in the direction of easing. And therefore, the decision of the Reserve Bank of India has been appropriate. Going ahead, I think much will depend upon how inflation behaves. The headline inflation, even as of now, remains at a high level, and this is a factor that no policymaker can ignore. So going ahead, unless we see continuing decline in inflation, it becomes very difficult. But at this point, we can't clearly say what turn the policy will take. We need to wait and watch how inflation behaves.
Dr. Rangarajan, if I might just ask you a question here. About a week ago, Dr. Subbarao, speaking in London, had said any inflation over 6% would justify, in fact, warrant a tightening of monetary policy. But on the other hand, even though inflation is well over 6%, he has eased policy. So is that more, should I say, in response to populist pressures and expectations that had already been factored in? The alternative of not lowering rates would have been too drastic. Is that rather than macroeconomic fundamentals which have driven the policy?
No, I think the fact that non-food manufacturing inflation has come below 4%, what must have been a major factor influencing the decision. Undoubtedly, the overall inflation, the headline inflation remains high, and that is also a factor in deciding the extent of easing that he can do. Therefore, there are two factors moving in opposite direction. What is considered to be under the control of the authorities, namely non-food manufacturing inflation, has come down. But on the other hand, the headline inflation has gone up. Therefore, one has to do some kind of a balancing act here.
Absolutely. He has had to do a bit of a tightrope walking. But on the other hand, there is also the issue of that when you lower interest rates, it is likely to impact household domestic savings. Already we've seen households moving out of bank deposits into gold, real estate. So something like this, is it not likely to hit domestic savings even more adversely?
Well, it all depends upon how the banks react to the change. I do believe that the Reserve Bank of India will take some action through the open market operations if the required liquidity is required, because the very act of reducing the policy rate does not automatically result in the other rates coming down unless the Reserve Bank of India also takes complementary action. Since they have not done anything on CRR, probably they may do something in a calibrated way through open market operations. Yes, your concern is very genuine. That is why we need to bring down the overall headline inflation, because what matters to the consumers and what matters to the savers is the overall inflation rather than a subset of it. Therefore, we need to act on that. I think this is a very difficult balancing act. There are competing claims on the policymakers and on the system. On the one hand, growth has slowed and therefore growth needs to be pushed up. But at the same time, inflation remains high and we need to take action to control inflation. So we need to be doing constantly a balancing act.
Absolutely. I think the hope is that if banks are willing to compress their margin, keep deposit rates where they are while lower the lending rate, that really would be the answer. But how do you see this impacting the current account deficit? With a lower interest rate, you're going to see more demand pressures. So would that not impact the current account deficit even more adversely? And really, that is the bigger worry. Rather than the fiscal deficit, today the current account deficit is the bigger worry. So how will this play out on the current account deficit, sir?
I think the current account deficit is many dimensions. I think the rate of interest, of course, normally should be raised when the current account deficit is high. That is the standard approach to the problem. But I do believe that in the current context of the high level of current account deficit, we need to take action on many other things. Probably the fiscal consolidation and maintaining the fiscal deficit at a lower level will have much greater impact on containing demand pressures and therefore impacting the current account deficit in the right direction. And also we need to look at some elements in the trade deficit which are not directly attributable to the rate of interest or which are not directly attributable to the exchange rate. I referred both to gold and as well as oil. We need to take some action in order to be able to contain those elements which are insensitive to changes in the exchange rate and perhaps insensitive to changes in the interest rate. There is a much broader policy front on which action is required in order to contain the current account deficit.
Just one last question, sir. How do you think that with this policy? Just one last question, sir, if I may repeat. Do you think that with this policy, the RBI has clearly indicated that the ball is now in the government's court? It has done whatever it could, and now it is over to the government.
Well, I think the government has said that it has done whatever it could, and it is for the Reserve Bank now to act. So what boils down to is that both the monetary authorities and the fiscal authorities have to work together, hand in hand, in order to contain the demand pressures in the system if inflation is to be brought down and the growth stimulus is to pick up.
Okay. Dr. Rangarajan, thank you so much for joining in with that perspective right here on ET Now.